you've watched this channel and seen my last videos, you know I was basically short the market this week and I lost $10,000 making that stupid bet. And even more embarrassingly, or stupidly, is that a word? I went back on all the investing principles I know and all the investing principles that have made me a good investor in the past, and basically day traded, right? And that's everything I don't want this channel to be and everything that I traditionally don't do as an investor. And I regret it. I made a mistake. So in this video, I'm going to talk about what I did, what went wrong, what I'm going to do now. If you've watched this channel for a while, I did videos. I used to do videos in an office in my house. It was really loud. I loved being home, but had kids in the background making noise and stuff. And it became stressful for my kids and my wife. I've got young kids, or our nanny, which is my mom. She watches our kids when we're working, to have to try to like keep our kids quiet when I was trying to work or record videos or whatever. And so rented an office space. It's like a shared kind of co-working type space. I get my own private office, $850 a month, and it's going to let me focus a lot more. And it's actually, even though I'm away from home, going to increase my work-life balance, because now I can't just go work in between or at night. Like I've got to be more organized and more deliberate, I guess, about my time. I don't know if that's the right word. So I think I'll actually be more present at home, and it'll be better, and it'll definitely be better for my family at home, because they don't have to be stressed out about, the kids being able to just run around the house and have fun if I'm trying to record a video. So that's an update. Let's get into this. All right. I promised you I would be transparent, and I'm being transparent. All right. Last thing, I've also gotten feedback about the different things I've done with this channel, and people like subscribing for the transparency and the authenticity and like sharing my journey and the research. And then I've kind of like changed it up on you and done different types of videos. I'm going to get back to what the reason people subscribe to this channel in the first place. I think if you subscribe because I share my portfolio transparently. I most of the time talk about long-term investing and share what I try to make quality research, which is not common. I talk about high quality companies for the most part. And I'm just authentic, I guess, in myself, right? And it's like not a high production value of these videos. I record them and edit them myself. People seem to like that. And then I kind of disappointed a lot of people. And so I'm going to get back to my old style of videos and just sharing this journey with you. I truly am trying to build $1 million portfolio. All right, let's get to it for anybody that's still watching. And we'll go full screen here so you can see everything. Okay, here's what I did. And I'm just going to cover this briefly. And I really want to just like cover lessons of what not to do, right? This is my email newsletter, investor.beehiiv.com. Check it out if you want to, but I'm covering it right here on YouTube. There is a link down in the description below. Yep, threw $10,000 in the trash. This was my portfolio, I think on Wednesday when I sent this update. I was down $9,000 for the week, down 6%. Fortunately, I was still up 15% on the year, up $18,000, but I could have been up $28,000 at that point for the year if I didn't give that back, right? So I do think the market is overvalued, right? Like I still think that, and a lot of smart people think that, but it's crazy. I read a lot of Howard Marks, right? Howard Marks is this legendary investor, and he talks about having opinions on the market, but not acting on those opinions. And I acted on my opinion, and I learned a lesson, right? Anyways, I think we're also probably headed into a recession, and there's a lot of stocks that seem like they're back to bubble type valuations. What I did was I used SQQQ, which is a 3 times leveraged ETF. So stupid when I talk about it, right? And TLT, which is actually like not a super risky thing. That's just like 20-year bonds. And if you think we're going into a recession, if you think rates are going down, like that's not a super risky, dumb idea. The problem is I switched up from long-term investor, long-term stocks into this like market timing thing. If I had just done TLT, fine. This was the idiotic part, SQQQ, at least for who I am and how I invest. And I am trying to educate people about good investing habits. And so from that standpoint, it was also dumb, right? Like I've built this, it's only 6,000 subscribers here on YouTube, much smaller than other people, but that's still a lot of people. And like, what am I doing even sharing that? Like I didn't want to share it because I don't want to influence people the wrong way, but I shared it because the most important thing to me is to be transparent. So that's why I shared it. Anyways, I was trying to avoid potentially losing. I'm trying to just go to this so it doesn't time out because I'm going to show you my current portfolio. Potentially losing 10 to 20% in a stock in a market-wide pullback. Like who cares? Who cares about a 10 to 20% loss? Who cares? But then I lost 6% while the market was up. So an opportunity cost, it probably did cost me 8 to 9%. And yeah, taxes and stuff, just a dumb move. Now I was faced with a decision. I could stick to my guns or even double down because now the market's even higher. I'm more convinced it's overvalued. Remember, I wrote this on Wednesday. But that's not what I'm going to do. I swallowed my pride, admit I made a really stupid decision, get back to investing the way I know how to. And so, spoiler alert, that's what this channel is getting back to. Investing the way I know how to. And like, truly, how cool would it be if 20 years from now I'm still building this channel and owning stocks long term? And I've brought people on this journey with me where you can see the portfolio growing from $150,000 today to $5 million in 20 years from now, whatever it is. I don't know what it's going to be, but like, how cool would that be? And then seeing like the cost basis on stocks and just actually holding them long term. Like that's the example I want to set, right? Anyways, buying great companies that I want to own long term, figure out how to pile as much money as possible into the market over the next 20 plus years while still spending money on things I enjoy in life. Again, trying to not lose this. All right. One thing that many investors don't talk about is the non-investing costs of their style of investing. Tell you for damn sure, investing in a way where I'm constantly adjusting my portfolio, shorting and worried about losing 5 to 10% is a miserable way to live. Over the last few weeks, I wasn't exercising nearly enough. I haven't been present with my family, and I was just obsessed with the market. And I'll come back to me right here. And like, and literally, I switched back to long-term investing on Wednesday. And I know I'm going to get criticized for like jumping back in, but like, that's truly what I think is the right thing to do. Whether the market goes down or not, who cares? If it goes down, I'm going to buy more. I'm going to keep buying. Not like crappy meme stocks and junk companies, but like real high quality companies. Those are the ones you want to buy in a downturn. It's not like crazy dumb buy the dip, like carelessly. Buy the dip is great if you're not reckless about it. Anyways, just since Wednesday, it's Friday right now. Just since Wednesday, when I stopped doing that crap, I promise you, I've slept better. I've exercised. I've gotten back to exercise. Woke up early, went for my run. I ran yesterday. I've been more present with my family. I've just done better work, higher quality work, and my quality of life is so much better. And I will give 30% of my portfolio any year to not live the way that I was living it was only a week that I was doing it or whatever, but like just for that week, I was miserable. And this, even though it was a stupid mistake, like this is the wake up call that I needed. And it's going to make me a better investor, a better person, a better father, a better husband, as stupid as that sounds, right? Like, because it's the stock market and the YouTube channel and money. But I don't know, sometimes you need a wake up call and you need to get back on track. And I think this $10,000 mistake is probably going to make me $1 million in the future because I learned what I don't want to do, what I shouldn't do. And now I'm never going to make that mistake again. I'm never going to make that mistake again. I'm not going to get scared out of the market, because I'm going to make sure I'm investing in a way that doesn't force me to get scared out of the market. Anyways, I'm done with that stuff. Let's get to the portfolio, right? That's why you're here. All right, here's a portfolio, $150,000. And what a day today, right? It's only one day, I get it, but what a day today, up 2.3% just today alone, one day, $3,380 gain. And I might give this back next week. Who knows? Who cares though? It doesn't matter. And still, even with that boneheaded move over the last week, I'm only down $2,843. Over the last month, down about $8,000. This quarter, up $20,000, up 16%. Year to date, up $21,000. And then all time, started this on February 15th, 2022, down $4,656, down 5%, which is still better than the S&P 500 since then. And let's get to the companies, right? Let's get to the companies in the portfolio. And I'm going to walk through a couple examples of like why I bought back into some of the companies I did. And yeah, that's what this channel is about, right? So let's share that stuff. Datadog. All right, you know that I owned Datadog for a long time. Not a long time, but through 2022, like the entirety of this channel, basically. And I sold it in February at about $88 a share. And I actually just bought back at $67 a share, which, you know, it's $20 lower than $88 a share. So I don't know, saved a 25% loss. So at least I made a good decision there. But in the long, like grand scheme of things, probably would have been better off just hanging on to it anyways, and maybe just not adding to it or whatever. All right. The companies, and this is from largest to smallest, and you can see, so the small number up here is the actual percentage of the portfolio. The bold white number is the target percentage of the portfolio. Datadog, Lowe's, Viva Systems, Realty Income, Global Payments, Markel, Charles Schwab, Lithia Motors, Public Storage, Perimeter Solutions, Enterprise Product Partners, Magellan Midstream Partnership, and then CNX Resources. Some different companies in here, right? And I'm doing a lot of reading. My focus is deeply reading some of the best investors of all time, the investors that I've learned the most from. Right now, I'm studying Markel, Tom Gaynor, Warren Buffett, you know, their style of investing. And also Will Thorndike, who is the author of The Outsiders. He studied a bunch of companies that just crushed the S&P 500 for like 25 years. And he is actually on the board of CNX Resources and Perimeter Solutions. And then Nick Howley, who I believe was CEO or is CEO of TransDigm, that stock has returned like 35% per year over the last 20 years or 16 years, something crazy. TransDigm has. He's actually on the board of Perimeter Solutions, right? And I'll share more about these two companies. They're small, like around $1 billion companies. But I mean, just Will Thorndike and his style of investing and decision-making alone, being involved in these two companies, and then Nick Howley being involved with Perimeter Solutions, makes me very, like that alone is almost enough to own a small piece of these two companies just for that potential upside because of their track records. But after studying the businesses, I'm actually excited about it. I'm going to do full videos on both of them. All right, let's jump into an example of just like why, just quickly, like why I'm not going to be concerned about 30% drops in companies. And the fact of the matter is it happens. And if you want to own a piece of any great business over the long term, make a lot of money, you have to be willing to withstand 30% drawdowns. This is Meta. And you can see right here, I mean, all of these, right? In 2018, they had a 40% drawdown. In COVID, obviously, who saw that? 32% drawdown. And then, oh, this is crazy. From 2021 to basically November of 2022, holy cow, a 76% drawdown. That doesn't even feel accurate. I guess it is. I don't know. And now Meta has recovered. It's up 126% since last year, which I owned it for a lot of that. And I shared that. But And so if even with all those drops though, all those crazy drops, if you look at Meta, this is since from 2013 to 2023, it has still earned 21% per year. That's changed a $10,000 initial investment into an $82,000 investment. So in 7 or 8x your return, 21% per year in 10 years. Just amazing, right? You're not going to get that type of return if you're constantly trading in and out, and then much less taxes and stuff like that. Okay. And why did I not buy Meta again? Well, it's actually traded back up. It's now at a blended price to earnings ratio of 23. When I was crazy about buying it, it was back when, Meta had a PE of 14 down to 13, even down in the 9s. That's when I was like pounding the table on Meta. And now it's rebounded a lot to where it's undervalued. This right here, this blue line is its average PE over the last 20 years. It's undervalued when you look at that, but I wouldn't expect it to be at a 33 PE, right? If you look at Meta, and we can just like put in right now, I'm just putting in analyst growth estimates, and you can see right here, these are analyst growth estimates for earnings per share over the next few years. And if we want to take it to like a 21 PE through 2025, you're looking at a 14% annualized return, which is great. But let's say around 18 or something like that. That gets you 7.7% total annual return, which is a good return. It's a very solid company. It's just not the screaming value that I think it was back when it was down at a 10, 9, 11 PE. That's my thoughts on Meta. All right. Why did I get back into Datadog? Well, Datadog is now trading at a blended price sales ratio. This is the trailing 12 months plus forward of 12, right? And if we look at how they've grown revenue historically, 66% revenue growth per share in 2021, 60% revenue growth per share in 2022. And again, you'll see their revenue growth numbers be different than this. This is per share. So this takes into account share dilution when they have more shares than they did. So this number is going to be lower than what their revenue growth number was. And so basically, I'm a big fan of the company. And again, I'll get more into why in future videos, but just using this, the simple analyst estimates, you can get close enough to think that and to decide that, you could make money off of this investment from here. And so it's trading at, again, its blended price sales ratio of 12. It got just way extremely overvalued, 44, 34, 20, a price sales ratio of 25. And now it's trading near its low price sales ratio. But anyways, from here, and so if you go out 3 years with analyst expectations of 22% revenue growth per year, 27%, and then 34, that one might be a little high. So let's even just be more conservative than that. Let's bring that down. Let's see what happens at 10. Okay, we'll go to 10, right? So 20% revenue growth in 2025. At a price sales ratio of 10, you're getting a 15% annualized return. And I think that's about where the price sales ratio could or should be if it's growing, that fast. And that might even be conservative estimates, right? But even down to a price sales ratio of 9, you're still getting 11% annualized return. Down to a price sales ratio of 8, which I think is like a bear case, you're still getting a 6% annualized return. So if Datadog is going to surprise from here, I think they surprise to the upside. They have stronger revenue growth, and I don't need it to trade at a higher price sales ratio, but anywhere between 8 to 10 is reasonable for a stock like Datadog, in my opinion. And I like those odds from there, and then to keep growing for many, many years. All right. And now that we're done with Datadog, let's jump over to Enterprise Product Partners. This is a MLP, Master Limited Partnership. So they pay a high dividend. They're in the natural gas space, right? And essentially, my thesis is just that I think we're going to need natural gas for a long time. I'm not an expert, but I think the U.S., if anything, is going to export more natural gas as other countries might need it. We're going to be more reliant on our own natural gas as well. And again, this is just a company that's paid a dividend for a very long time. And even though the stock hasn't knocked the lights out, when you factor in the dividends, this is over the last, since 2003, you're still got almost 12% return per year. A $10,000 investment has paid $60,000 just in dividends, which is pretty awesome. And for total growth of $96,000. And so that's grown all the way from a 72-cent per share dividend to $1.88, which if you bought shares back in 2003, you were making a 66% yield on cost per share you paid back then if you still hold the stock today, which is just amazing, right? And so if we look at it from a price operating cash flow ratio, then it's got a blended price operating cash flow of around 7. You can see this blue line here has been its average over the last 20 years. There's a lot of times it's traded higher than that. Natural gas prices have been very low, especially since COVID. Even back before COVID, it was trading at about a 9.5, right? So we're under that. And now, I mean, if you just take this thing out based on some pretty modest expectations over the next year up to 10 or 11, you got a total annualized return of 21%. And that doesn't take into account dividends. So if we go to the forecasting calculator, and again, we're going to do analyst estimates. So they've got estimates, only 3 of them, but they've got them out to 2025. And we want to take it up to a price operating cash flow of, we'll go 9 on the high side. You're going to get a 21% annualized return. So that's going to be 46%, the share price going up. And then so that's a 15% annualized return without the dividend. But then you're going to get $5.83 of dividends for a total gain of $17.90 a share, which comes out to be 69% total, or 21% per year. And even if you get down to price operating cash flow 7.8, still a 15% annualized return. And then price operating cash flow is 6.5, still almost a 10% annualized return, 9%. So that's why I own this one. And Magellan Midstream, same thing, to play on, commodity prices potentially going higher too. I mean, not a play, but it protects you from that. And they've just got a long track record of success, paid a lot of dividends. So it'll give some nice dividend income. So if you like this content, if you learn anything, like the video, that helps the algorithm, that helps YouTube recommend it to more people. You can subscribe to the channel. That helps me as well. And then check out my email newsletter, investor.beehiiv.com, where you can subscribe and get my stock research and get different types of things. And if you don't want to, totally fine. You'll still get my YouTube videos right here.